Hello, it's Jeff McDermott with Create Wealth Financial Planning. It's October 3rd, 2025. This is our third quarter market recap. We're going to spend 5 to 10 minutes just reflecting on what we saw in the third quarter of 2025, what we'll be watching over the next few months. If you're a client, thank you for your continued trust and working together. If you haven't scheduled your fall review meeting yet, use the link I sent in the email to do so. If you're not a client, you'd like to know more about what it's like to work with Create Wealth Financial Planning, go to my website, createwealthfp.com, and schedule an intro call for us to get to know each other a little bit and subscribe to this channel for more videos as they come out. So, after a little bit of a scare in April of this year with the markets, second quarter recovered very well. Third quarter, the markets have really continued forward. And I like to use this chart to show us how important diversification is and how we can build a really nice portfolio. You have the U.S. stock market, the S&P 500 here in the green line, international stocks represented by the blue line, and bonds represented by the orange line here. And depending on the mix of your portfolio and how aggressive you are, a lot of investors are seeing S&P 500 like returns for the year in a diversified portfolio that's not solely concentrated in the S&P 500. You have bonds holding up the bottom and helping with clients, especially that are a little more conservative. You have international stocks that have outpaced U.S. stocks for this year and really have pulled things up a little bit. So we're getting a very good risk versus reward trade-off with those balanced portfolios. And again, just a reminder of why we don't put all of our eggs in one basket. Market's doing very well though. Might wonder, there's a lot of headlines out there, a lot of what sounds like bad news. Why is the market doing so well, even though things feel a little bit treacherous? So let's take some time today to walk through some of the headwinds we might be worried about and then what's happening to continue to boost markets. And the tariff situation is something that is still in the news, I think still really filtering its way through the economy and the markets. And we can look at this chart of gross domestic product GDP for one sign of that. I like to go all the way out to the end here where we have the first and second quarter of this year and look at these dark blue bars. Change in inventories. Companies buying up, spending a lot of money, building inventories ahead of the tariffs at so-called Liberation Day in the beginning of April. And then the second quarter, a lot of drawdown of those inventories. So again, just a sign to me and a good example of how the tariff situation really is only just beginning to work its way through the economy as companies did a lot of buying before tariffs, selling a lot of those goods in the last few months, and again, still kind of figuring out, okay, what's going to come next with all of this. So again, this is just an interesting look at that. The jobs market is another thing that has a lot of people worried or concerned, and there are some things to be aware of there. On the left-hand side here, we have these, what they call the non-farm payroll gains or the jobs number that comes out every month. How many jobs has the economy added in a given month? It's that number that always gets revised and whatnot too. And you can see that's been a general decline since we came out of the pandemic, getting pretty low, almost and at one point going a little bit negative here in terms of job losses versus job growth. So the amount of jobs the economy is adding is declining, but the unemployment rate has pretty much stayed the same, and that's in part because the labor force, or the number of people in the job market, has also declined. A big component of that is the little blue box down here. Foreign-born workers for this, part of the year have pulled back quite a bit. Smaller amount in the labor pool. And so again, what you have is fewer and fewer jobs being created. You also have fewer people in the labor force, which you see in this graph down here, both working age people and the total labor force, excuse me. And it's kind of masking maybe some of the issues with the job market. Okay. Inflation still out there as well. Let me click over to that inflation chart. Here we go. So inflation, which was trending down, sort of moving in the right direction, has retrenched and come back up almost just a little bit. Again, things like shelter, things like auto insurance, those have continued to contract, but goods and services have re-expanded a little bit, have pushed inflation back up a little bit. And again, that's just another signal that this tariff situation is still working its way through the economy. We still not even close to probably fully realizing the effects. And so there's more to be seen, but inflation staying a little bit hot and creeping back up is making it difficult for the Federal Reserve to bring interest rates down as quickly as a lot of us would probably like. So, tariffs, inflation, job market, all potential concerns or things that we're looking at. But what's propelling the stock market up? What's keeping things moving? And I have to tell you, it really comes down to two letters: AI. Here is AI spending, which is driving the biggest names in the stock market. And this chart over here, the gray bars and then the shaded forecast for this year, next year in 2027, show the explosive growth of spending on AI and some of the major companies involved. And that is really pushing a lot of the spending, a lot of the growth in the stock market. Whatever happens out there, companies at the top of the food chain still have a lot of money to spend on this kind of infrastructure and on AI. And you can see here three specific components: semiconductors, communication equipment, computer equipment. Since the launch of Chat GPT, and we all kind of became aware of this, have all exploded past the rest of the economy in terms of production and output from these high-tech companies. And again, that's what makes the quote-unquote Magnificent Seven the Magnificent Seven, because they're all connected to this new wave of technology, of AI. Now, again, some concerns. A lot of people saying, hey, is there a bubble out there? Is this something we need to worry about? And I think that one thing to keep in mind, and something that's maybe different from the 2000 tech bubble, which I hear people bring up a lot, is the growth of the stock market is to a degree backed by a growth in earnings. So it's not a totally empty stock market rally. The companies making headlines with spending today: Nvidia, Microsoft, Oracle, Apple, these are all companies that have profits. They have cash flow, which is very different from the 2000s and the tech bubble, where we just had a lot of empty companies, a lot of ideas, companies with no earnings or negative earnings that eventually blew up. That's not to say we are not headed towards, some kind of a bubble territory here, especially with AI. That's why we diversify the portfolio and don't go all in on stocks like that. But, the slope of these lines is what really matters. And the slope of the stock market does have some commensurate slope of earnings alongside of it, right? It's not a totally empty rally. The trajectory is important. So why don't we just go all in on the mega cap tech companies and go all in on AI spending and things like that? Well, investors in Nvidia and other tech companies for the last few years will tell you that these stocks can have sudden and violent pullbacks. If you know when the music's going to stop on the party and you have the gift of hindsight, sure, we can say, hey, if I would have put all my money in these few stocks, that would have been the move. But we never know that. And again, with that reward comes the kind of risk. This is just the last 4 years of Nvidia and the measurement of pullbacks or drawdowns from the peak in the stock. And you have a 65% drop that investors had to weather in 2022. You had a 35% drop just earlier this year that investors had to deal with. Two big drawdowns just in the last 4 years with Nvidia, the biggest company in the stock market. And it's volatility that you have to be ready for. That's why we like to have it as a component of the portfolio, as part of the investment. And if you own the S&P, if you own any kind of large cap index, you own Nvidia and Apple and Facebook and all the big companies out there without having to go all in, right? From a long-term trend, this was a cool chart that I saw this week as well. These companies are big now. They're the top 10 right now. I can almost guarantee you they're not going to be the top 10 companies forever, right? Again, maybe for a long time, but at some point, these companies are going to be replaced. It's just the cycle of business and the markets and the industry and how it happens. This chart shows 1985, 95, 2005, 2015, and 2025, what the 10 largest companies in the S&P 500 by size, or we call it market capitalization, were at the beginning of each of those 10-year periods. At the beginning of 2025, you had 1, 2, 3, 4, 5, 6 companies here shaded in purple that were not part of the 10 biggest companies in 2015. And only one of those companies here, Microsoft in light blue, was one of the 10 biggest companies in 2025. Excuse me, 2005, 20 years ago. So over the last 10 years, this thing, 90% of it has cycled out. And over the last 20 years, the whole thing, has cycled in and out. You go back to 95, 1985, totally different list of companies there than you see today. And again, IBM, Exxon, General Electric, giant companies that at the time probably felt like never could have been replaced as the 10 biggest companies in the country. And here we are, they're nowhere to be found in 2025. So you can't hang on to these forever. Things are going to adjust. And again, by being broadly diversified, owning a wide range of companies in the stock market, you're always participating in the next great thing as the economy expands and as the stock market grows. Okay. One last quick point I want to make, since we are unfortunately in the midst of a government shutdown that started over the last couple of days. Really unfortunate for the folks that work for the government, have their employment tied to the government. There's people waiting on paychecks that aren't coming right now. Don't know how long it's going to last. The average government shutdown runs a couple of weeks, 10 to 15 days. Really hope everybody can get back to work very quickly. From a investment standpoint and thinking about the stock market and thinking long term, what this chart from Dimensional Advisors just shows is the last the last four government shutdowns that lasted for more than 5 days had no real direct effect on the stock market. Maybe some initial worries, some initial pullback there. They all ended even or higher. By the end of the shutdown, a 4-event sample size is not a large sample size, but it's just a point to say, if you are concerned at all about your investments and the government shutdown and what that may lead to, history tells us it's just another thing to say, hey, this is important for the people affected by it. It's not going to dramatically affect my stock portfolio, more than likely. Okay. Well, again, thanks very much for watching today. If you have any questions, please reach out. Any comments, please leave them below. Subscribe to the channel for more videos like this, and look forward to talking to you again sometime soon.